Good morning and welcome to the Walker Crips 2026 Market Outlook. My name is James Richards and I'm an investment director here in the private client team in London. Today, I'm very happy to be joined by Chris Darbyshire, our investment specialist, who will be giving us his outlook for the year ahead. There will be the opportunity to ask questions at the end, so please use the Q&A function at the bottom of the screen. But without further ado, Chris, over to you.
Thank you, James. I'm the lucky guy who doesn't have to wear a tie today. Let me share my screen and get things going. There we go. Okay, so as James has said, this is our market outlook for 2026. We've picked off a few themes that we think are going to be crucial this year. And I'll just spend a few seconds on our standard risk warnings. This is really designed for education. We're not making investment recommendations here. And the normal disclaimers apply. Okay, so major theme, European stock markets. And here is a chart showing a couple of things. The solid lines on this chart are the levels of two European stock markets. We've used the Eurostoxx 50 index, the light blue solid line, which is a sort of a blue chip index for continental European companies. And then we've got the FTSE 100 is the black line here. And you can see that these performances have done quite well, particularly going back over the last year or so. And in fact, that sort of upward trend becomes much more distinct around Liberation Day, just after Liberation Day last year. However, also on this chart, we have the dotted lines, and the dotted lines are the profits, the aggregate profits generated by companies in those stock market indexes. So you can see the dotted lines are trending sideways. Hasn't really been much, if any, growth in profits since the beginning of this chart, which is 1st of January 2023. And when profits are flatlining, but the index is going up, your stock price is going up, then investors are anticipating more profits in the future. They're putting a higher valuation on that stream of profits. It's symbolic of confidence. Where are those profits going to come from? Because, of course, if the profits don't materialize, and we've seen this many times in European stock markets over the last 15 years, they can come crashing down and disappoint. And we've had many false starts in European markets over this decade, since the great financial crisis. Well, it's probably not going to come from the economy. You know, the economies, the UK, continental European economies are really mired in stagnancy. You know, their growth is about 1% per annum. 1.2 is considered good. 1.4, people get ecstatic about, you know, percentage growth. But these are not high numbers. You know, pre the GFC, growth was up around 2%. You know, in the teens, growth was in the mid, you know, between 1 and 2%. So we are stagnating. Economies are stagnating. And that's partly because we have demographic issues, you know, people retiring, the workforce getting smaller. It's partly because we do not have a technology sector. And the technology sector in America has generated most of the economic growth over that, you know, over the past couple of decades. So how are we going to break out of that? Well, there's no immediate solution. Governments are, you know, they're constrained by finances. You know, governments really pushed the boat out after the pandemic. They spent a lot of money on stimulus. There's not a lot of, you know, gas left in the tank, really, to try and stimulate the economy through government spending. If anything, it has to go the other way, and governments actually have to rein in their expenditure and raise taxes, which will hurt the economy for a period of time to stabilize that, you know, government debt burden so we can kind of go back to normal policies designed to create growth. And every country has this problem, you know, pretty much every country in the developed world. It just doesn't manifest itself all the time in all the countries. We also have the problem that tariffs, you know, Trump and NATO are beginning to become a source of government spending, a source of government, maybe subsidies for industries that have been affected will probably happen. Obviously, we know about NATO and the higher military spending required to keep the Americans happy. But that is not good spending from a government's point of view. It doesn't really hit voters in the pocket very much. It will add to GDP growth, but it's unproductive spending, because what you really want that military equipment to do is sit in a warehouse and never get used in anger. So it's one of the least productive forms of investment. Just when we need, a bit of leeway, the government spending level, we get hit by Trump and NATO with extra spending requirements. Now, voters are not happy. Voters are still tending to move towards fringe parties, populist parties, whatever you want to call them, parties that are really a shock to the system. Parties that are promising to really wholesale change the way the political system works. And that those parties are unlikely to stop spending. In fact, typically populist parties end up spending just as much as normal parties, but just with different sort of objectives. So we're not, going to solve this problem. We're going to be stuck in this sort of stagnation. We've got political risks developing. Three governments fell in continental Europe last year, in Germany, France, and the Netherlands, and the political centre is crumbling. Certainly in the UK as well. So problems abound. For the first time, the American government is getting politically active in elections in Europe, helping, either directly or via the tech companies, helping, the challengers to challenge the incumbents, something very unusual. And of course, Russia is still a major risk and a major threat to Europe. Trump seems to favor Russia in his policies, tipping the balance a little bit more in their favor and against Europe. So this chart is really, I think, an illustration of vulnerability. It's an illustration of market complacency in the face of growing risks, and the lessons we've learned many times about economic stagnation. Moving on, how does this sort of market complacency come to an end? Well, the AI boom is a very good example of a potential catalyst. We use the word AI bubble here. I think it's become much more conventional to refer to it as a bubble since November, when we began to get some wobbles in the market driven by AI and expectations for AI not really being realized. This chart is a complicated chart, but it is showing the linkages between companies involved in AI. So at the center of the chart, we have NVIDIA, the poster child for AI, the maker of the advanced semiconductor chips that power large language models, which is one of the main assets of AI companies. Now, NVIDIA is making a lot of money, and it's using some of that money to invest in its own clients. So, for example, NVIDIA is investing in OpenAI. So if you look at the sort of bottom left, you can see an arrow going from NVIDIA, which agrees to invest, you can see from the chart, up to $100 billion in OpenAI. Now, some of that money will go back to NVIDIA in the form of purchases of NVIDIA semiconductors by OpenAI. So you're investing money in your customers so they can buy your product. These are the kinds of things that would not normally go down well among investors, but AI technology generally, it lives in a bit of a world of its own. The normal rules don't apply, so these companies are getting away with it. But the chart shows you just how sort of incestuous the industry has become and how complicated it's become. And any one point of weakness in this network could threaten to bring other players in the network down, even though the linkages might not be direct. So this is really, for me, the catalyst that could cause the sort of high valuations we're seeing in markets, the confidence among investors to come to an end. And you never really can put your finger on what's going to break, investor sentiment. It took a year for the internet boom to die. However, let's just have a look at the, what is AI itself, and AI itself, is really a type of software built around what's called a large language model. And a large language model requires an awful lot of semiconductor chips from NVIDIA and others. It requires data centers that basically produce the computing power to enable sophisticated searches and questions and queries to be done. So this is a very different business model from the internet boom, where once companies got to a certain level of size and once the network had built out, everybody joined. It didn't really, the network and, the company got a great market position, but it didn't really cost the company any more to add an extra user. This is different. If OpenAI gets an extra user, it's going to have to pay for that user's queries. It's going to have to supply that user with massive amounts of computing power, depending on the computer intensiveness of the questions and the usage. So it's a very different business model, and it's much more competitive. There are many companies out there with large language models. OpenAI has ChatGPT, which sort of started the whole boom going way back in March, I think 2023. XAI, over to the middle right, is the part of the Elon Musk empire that has its own Grok large language model, and Anthropic over on the far right has its Claude large language model. So, the main asset here is facing a great deal of competition, and that's just the West. In China, they have proved that they can compete on our terms, Western terms, with these companies for a fraction of the price. So there's another form of competition in terms of making the product more efficient and making it cheaper, which the original internet companies didn't really have to deal with. In fact, as time went on, they could make their product, they could charge more for the product because the network had been built out and they dominated. That brings me to valuations, because you need the bubble. The word bubble really applies to the valuations here much more even than to the business models. So let's have a look at some of the valuations. So interesting if you look at the OpenAI valuation on this chart, again, slightly bottom left corner, it says 500 billion, but just recently we've seen news that they're looking to raise money at a valuation of closer to $800 billion. Now, we think the annually recurring revenues of OpenAI are about $13 billion a year. Now, that is obviously a moving target, and it's moving upwards. Question is really how fast is it moving upwards? But on $13 billion, that is a multiple of revenues, not a multiple of profits, a multiple of revenues of 62 times. So pretty punchy stuff. That pales in comparison to XAI. So the XAI business, which the last public information suggests it was making less than $1 billion a year in terms of revenues, but is valued at 230 billion. That is a multiple of revenues of 511 times, just, mind-blowing stuff. And then just moving on to Anthropic, another of the big sort of pure play AI companies, that has revenues recently disclosed, actually this week, of about 9 billion annualized, putting that on a revenue multiple of a mere 39 times. So these are incredible numbers. Even more incredible are the commitments. So we don't have a lot of detail on this, but we do know, because OpenAI has publicized its commitments, the commitments to buy semiconductor chips, commitments to build data centers. OpenAI's commitments currently stand at about $1.4 trillion. That is the size of the GDP of a decent sized country. We don't know what cash is in the balance sheet. Presumably it's more than the figure of $14 billion, which it disclosed, I think, in July. But probably not that much more, because it's burning through cash at a very rapid rate. So $14 billion, let's call it, for the sake of argument, on the balance sheet, and $1.4 trillion in commitments that have to be funded. So you can see the bubble is there. It's there in the numbers. Investor sentiment is the kind of thing that it works until it doesn't work. And when investors decide to not like something, the market can go the other way and far beyond sort of rational predictions in the other direction. So we do feel that there is a huge risk here.
So, Chris, are we saying this is a house of cards like the dot-com bubble, or is there more to it? The big players like Microsoft and Alphabet and Amazon clearly have other revenue streams as well. Should be protecting them.
I think that's right. I mean, I think the difference this time around is that there are the Microsofts, there are the Amazons of the world, as you say, which have got diversified business models, have got very good business models, and they can fund pure play large language model development. Having said that, their money is still going to the same places that OpenAI's money is going to, and Anthropic's, which is NVIDIA. So they still stand to lose. They just don't stand to really get into serious trouble. Their balance sheets are probably going to survive this, whereas OpenAI's, I think, fair to say, reasonable to say it's at great risk. What does worry me, though, is that the US thinking on AI seems to be tending towards finding some kind of super intelligent, some kind of unique application, unique software that will suddenly, put the human race out of a job. Will suddenly do things better than humans on a massive scale. Now, that is a winner-takes-all business model. And so part of the money going into this is not being done, it's not going in on a rational, normal investment basis where you think you can build a business. It's going in because you think, well, if there is this sort of goal at the end of the rainbow, well, I might as well chase it because the returns are going to be, infinite, basically, to the winner here. And this, again, creates risk because there can only be one winner, or one or two winners, let's say, in the race for super intelligence. And that's a very different type of business model from the Chinese approach, which is build something useful, serviceable, can do lots of things for people at a very cheap, efficient rate. Let's also not forget, the cost of electricity and power in China is much, much lower than it is in America and in the Western world. And they've sort of, in a way, they've overdeveloped data centers in China. They've overdeveloped their energy production capacity. So they're going to be able to fund the development of AI much more cheaply. In fact, we're seeing users of AI going to China to develop their product, using Chinese companies and resources to develop the product until it gets to the stage where it's a marketable app, and then they bring it back into the Western world. So, this is not going to be straightforward. The competitive pressures, very different. The business model itself, very dependent on energy, very dependent on big capital expenditure. It looks more like an industrial revolution, really, than a pure sort of software boom, like the old internet boom. But I do think House of Cards is a good expression, really. You look at these valuations, when you look at that network, the network is there because they felt the need to invest in other businesses to keep the show on the road rather than invest in their own business. As investors, we want companies that have a good business model that invest in their own business. We can see that, we can then go along with them. Whereas these companies have already, even before they've even got to a stage of having a universally known product, they are already beginning to sort of diversify, invest in others, get away from their own business model. NVIDIA's buying back its own shares. You don't really like to see that as a long-term investor. You like to see them plowing their money into better semiconductor chips. Right. So there are other outside of the AI boom or bubble. And this chart is based on work by a geopolitical consultancy called Eurasia Group. And they're well known, big firm in that part of the consultancy world. And they have pointed out that one of their main risks for 2026 is actually the US government and the sort of nature and the changing style. Trump's style, his policies are very unusual. And in this table, which is, again, rather complicated table, they've broken down his policies into 4 quadrants. starting on the bottom left, they've got what they call business as usual. So things like the government shutdown is pretty normal in US politics. We had one in Trump 1.0. We've had one in Trump 2.0. We might get another one starting at the end of the week if the new, looking at the news today. We've got some unusual stuff, but it just about qualifies as business as usual, nothing to worry about. Moving sort of up and above this quadrant to the sort of top left-hand quadrant, we have stuff which is norm breaking. These are departures from normal political behavior in the US, but unlikely to be so serious that it breaks the system. And we have some interesting things in here. So we have trade deals, we have threatening the Fed in here, norm breaking, but maybe the system can survive it. We have US government interference in NVIDIA's business, selling chips, wanting license payments and revenue sharing arrangements with US exporters. We have the sort of anti-immigration drive in here. We have, various sort of bullying tactics, and we have Trump's family business interests, which are unusually large and linked to policy through crypto and stable coins and so on. So this is all stuff which is very, very unusual, but US can survive this. And then moving to the top right, we have what they call revolutionary policies. And these are things where no one really knows how this is going to end. And the law of unintended consequences applies here. And, US society, civil society could go along quite nicely and not be bothered by this at all. We could hit our midterm elections, and it might all be fine. On the other hand, these things are so beyond the pale in terms of where are they legal? Certainly not conventional, that it really puts American government into a new era. And that is the point of this chart, that we don't really know what the US government, and in particular governance in the US, is going to look like by the end of the year. So let's have a look at this top right quadrant. So we've got, firing Fed officials because you don't happen to like their politics. We've got shutting down government departments. We've got, prosecuting law firms. So going after the law firms to stop them acting on behalf of parties that might disagree with your politics. We've got the firing of the independent commissioners of departments of government, and the deployment of the National Guard and ICE to various American cities. And, it's important to remember, having armed troops on the streets of your city is not really your normal, not normal anywhere in the Western world, and not normal in America. So these are, we've got tariffs, this sort of emergency tariffs, the Liberation Day tariffs, the ones that are threatened by legal action in here as well. So these are things that are totally new and different. No one really knows if they're legal. They end up with the Supreme Court in America, which may or may not rule. But they are creating a risk to civil society in America, and the risk of civil unrest is growing. But of course, this is a country that has, 300 to 500 million guns, depending on whose estimates you look at. And, 1/3 of every adult in the US owns a gun. So there are some strange things out there in the world that don't materialize yet as risks on investors' radars, but you just don't really know what a risk is until it turns around and punches you in the face.
And that's the surprising thing, Chris, that the market has taken a lot of this in its stride, perhaps worryingly, perhaps thankfully. One of the key ones for me is the Lisa Cook firing and implications for Fed independence. If that actually does come through, do you think that might be the thing that sort of the market suddenly takes things seriously?
Yeah, and I think you make a really good point there, because the Fed is the one that you would have expected bond markets to have sold off a bit by now. If this happened in the UK or France, another major country, markets would be suffering. I mean, over the last week, we've seen gilt markets get hit because Andy Burnham has a chance of becoming an MP. Markets are quick to act when they see any kind of political risk coming down the pipeline. Whereas here, we've got massive amounts of unprecedented political risk in one of the biggest markets in the world, the US Treasury market, that underlies a lot of other markets, provides stability in the world of finance. The way you'd expect to see a reaction, we've seen nothing. And in fact, I think markets celebrate Trump. The equity markets, I think, like Trump. I think they believe he's on their side. So the markets have gone up. Since Liberation Day, markets are well up beyond where they were at the time of the announcement of tariffs. So I think there's almost a perception that these things are good. Trade deals are good, even though you're going from almost no tariffs to quite a high level of tariffs with various countries. Markets seem to be celebrating that, and I think that's fundamentally an error. I think it fundamentally points to complacency and sentiment being a big driver out there at the moment, which can only last so long. As I say, it works until that you should buy every dip until the last dip, as they say. So a lot of strange market conditions, strange risks out there. Now, moving from the present to the long term here. And this chart is produced by a research firm called Alpine Macro. They're part of Oxford Economics, a very well-regarded research firm. And what they looked into here was, look, let's just forget AI for a second. There are other technologies out there that need funding, that will change our lives. We're just, they're just not the sort of victim of fashion that AI is at the moment. And they've looked into various technologies and which countries are leading the charge. Now, we discussed earlier that AI is actually very much going to be driven by China as well as America. So we know the future, it's not going to be that sort of simple oligopoly of US tech companies. It's going to be a mix of the old US tech companies, possibly some AI players, and then probably some pretty big Chinese players. And who knows, maybe other countries will get a look in. Here is a look at other technologies that could become, important, that will become valuable, that, are capable of producing good companies, good investments. And let's start on the left here. We have the name of the technology, and then we have the next two columns. We have the extent to which the technology is dominated by one country and therefore prone to a monopoly. So you can see the pink is bad. Here it's a technology that is very dominated by one country, whereas green is good. There's a reasonable degree of competition. Then we have the country. So this is the crucial column, the lead country. And you'll notice that in most cases, it's actually China, not America. And so this is really, I think, eye-catching. And none of these, technologies have the market impact of AI. But nevertheless, it's important to remember they're out there. AI at some point will fall from grace and will become normal. And then other opportunities will come along. And China just does seem to lead in a lot of them. So the future could well look a lot more Chinese and a lot less American from an investor's point of view if you're looking for growth. And remember, we've commented on the difficulties of finding growth in the UK and Europe, growth really being only available in the technology sector. And here we are looking at new technology sectors that are dominated by China. So I think this goes across to another slide, actually. So let me just move the presentation. Also, we've got advanced aircraft engines here, drones, advanced robots. Again, an area where China really features very prominently. And the only technology on this slide, which is where America leads, is small satellites, and that would be Starlink and SpaceX's domination of the low Earth orbit, small satellites. So, as a long-term investor now, you need to be prepared to move assets out of America and into emerging markets. And not to say it, but China, and I wouldn't go rushing in. It's a complicated area to work with. And of course, there are political risks and geopolitical risks with the threat to Taiwan. So this is a tricky area, but there's no doubt about it. As long as China has a stock market and doesn't change its style of government substantially, that stock market is going to be producing investment opportunities for people in the West. Probably will become, I think, preeminent among the world stock markets, as I think the US will drop back as AI, the money plowed into AI really gets competed away, eroded away, particularly by China.
some caution for sure needed, but global diversification is.
I think that's right. Global diversification, you really only had, look, the last 15 years has been a choice of, do I invest in US tech or do I not? That's where growth really came from. And the lucky managers who put all their, money into US tech companies and stayed the course have done really well. But it's not going to look like that in the future. So you've got to pick your battles much more carefully here. And I think be a lot more open-minded about which political system you are prepared to stomach, from an investment point of view. And as I say, China's complicated. They have a lot of different stock markets, onshore and offshore. But the IPO market functions really well there at the moment. And all the sort of fuss and excitement in IPOs is happening in Hong Kong at the moment and not in the US. So they do seem to have taken that for investors in listed markets there, whereas a lot of the big still in hands like SpaceX and OpenAI and so on. So that brings us to looking at portfolio risk itself, and how do you while trying to manage for long-term growth and income, how do you control portfolio risks and sort of get over the next year or two, which are probably going to bring some surprises. And our slide here is simply pointing out that one good portfolio stabilizer for UK investors has actually been. So this chart shows you the performance of the pound against the dollar across various crises over the past 20 years. The great financial crisis here, Brexit is in here, COVID is in here. And we're starting as an index. And so if the pound falls by 10% during this crisis, the line on the chart will fall from 100 to 90 and so on. And immediately, the first thing you can see is that all the lines on this chart go down. So the pound has been, a reliable portfolio stabilizer because it has weakened in a crisis. So the pound, as we refer to it as a risk in portfolio construction, because it sells off in risky conditions and it tends to do quite well, relatively well, when markets are confident and people are, not averse to risk. Now let's have a look at some of the lines on the chart. Let's have a look at the black line. The black line is the 2022 bear market. And that ended really with the Liz Truss moment in the UK, which time the pound took another leg down. So you can see the black line over the course of that 150, this is trading days, so just under a year of poor market performance, fell nearly 20, actually over 20% against the dollar. So if you had a dollar asset, forgetting completely about what the price of that asset is doing, on a currency basis, created by 20% when you really needed it to. And that is the power of portfolio construction, avoid that difficult spot in the first place. So I've just put this in. It's an example of what we can do, to control portfolio. It's one of the factors that we have. There are other stabilizers, currencies are just one. Government bonds have been, historically regarded as a pretty good portfolio stabilizer. And I think in extremis, they will do quite well. I think the problem with the government bond market at the moment is that outside of those conditions, it's beginning to not look like a very good investment. Spending is off the rails. It's not coming back onto the rails anytime soon. And so you're now paying quite a heavy sort of, there's a potential for a heavy drag on your portfolios to hold an asset that will go up when other assets are going down. It's becoming a bit more of an expensive type of portfolio stabilizer. So those are the kinds of things we're looking for safe havens in different asset classes with different styles. In the equity markets, there are some unloved sectors which can be quite stable when markets sell off. So it's really, it's a challenging time, and one has to look, hard at how you've built the portfolio and the sort of links in the portfolio between the different assets to, to get the best outcomes. So I'll leave it there and just move on and allow time for some questions.
Excellent. And we have got time for a few. First question in actually on that last chart. Now, we're not saying that we're definitely going to have pound depreciation again in the current situation, possibly the other way around. We haven't mentioned gold and silver. That's a big topic at the moment. Does that give the same diversification it once did?
Well, let's just put the chart back up. And I do agree, actually, that right now the dollar is looking particularly weak, particularly vulnerable. So I wouldn't advocate this for ongoing portfolio positioning. However, if there was a serious collapse, ultimately risky assets are often denominated in dollars around the world. And to sell those assets at some point, you end up with dollars. So I do think that if there was a real, crisis in markets, eventually money would flow back to the dollar. So you would have this sort of rotation back to the dollar. But I'm certainly not advocating having a lot of dollar exposure at the moment. Secondly, on precious metals, you used to think of gold as being the quote end of the world trade. But when you look at the chart, it looks more like a cryptocurrency that's gone, completely crazy. And I don't think there's rational fundamentals underlying gold anymore. I think perhaps a few years ago, the buyer would have been, the main buyer would have been a central bank. However, I think now the main buyer, the marginal trader, as we call them, the one that moves the market, probably a retail investor somewhere in America or in China, buying a gold ETF, and really just chasing the momentum of this asset. And let's not forget, silver has outperformed gold massively. Platinum has outperformed gold by quite a lot. These are not metals that are held by central banks. So that there's something going on here that is not normal. It's a new era for these currencies of a more speculative holder. So unfortunately, I don't think I regard them as safe havens anymore. I regard them more as speculative assets.
Thank you. Another question, which I think you did touch on earlier, but on European earnings, should we expect the NATO increased defence spending to influence this? And it's just not sort of showing up in the numbers yet, or is it not big enough part of the market?
Yeah, that's a really good question. So the NATO defence spending is largely unfunded. Okay, so what this means is governments are saying they're going to do it, but they're not really making serious moves to dedicate money towards it. And this is because of the reasons that we've mentioned. There isn't really any money available, and that money has to go on keeping the voters happy who are about to vote you out, put a populist government in. So it's difficult. Governments really want to avoid spending on the military, but we all can see Trump is demanding it. Germany has sort of begun to get moving a little bit more than the others on this front. I don't think it's going to impact the numbers at an aggregate level. I think it will be a few tenths of a percent at most in terms of growth. And because of that, I don't think there's enough there to feed down into the profits of the companies in the market as a whole. And those companies that are directly in the line of fire in a good way, the Rheinmetalls of the world, the British Aerospaces of the world, companies that do have defense manufacturing businesses, the rate of change in their profits is not going to be massive, because building a new factory to build a new weapon takes a long time. And getting the development of that product and getting it into it takes time, and the market generously anticipated a lot of growth. The numbers that I showed you in the chart, forward-looking expectations, so be enough to change the trend of the dotted lines on this chart. I don't know what does.
Thank you. So an uncertain future, diversification and caution.
I think that's I think those are the themes for 2026. Yeah.
Excellent. Thank you. That's all we've got time for today. So thank you very much for listening, and Chris, thank you very much for your comments. Please do get in contact with your usual Walker Crips representative or use the details on screen now. And indeed, we will send a follow-up email. Please do just get in touch.